Decisions that last, home buying, step 3. How to choose a mortgage lender without sabotaging yourself. Before anything else, you need to understand how to choose a mortgage lender who will guide you through the process and not just sell you a product. Most buyers start their home search online. That's also where lender ads start to show up. And to be clear, many big name lenders are reputable and it can absolutely close loans. But they all share one limitation: they're not local. And local lenders are easier to reach, easier to hold accountable, and far easier to sit down with when something goes wrong, because something always goes wrong. When you're early in the buying process, choosing the right lender is one of the most important decisions you'll make. Not because of a rate quote, but because this person is about to learn more about your financial life than almost anyone else. If you haven't already gone through step 1, understanding your credit, and step 2, building a real budget, go back and do those first. Those 2 steps prepare you for the conversations you're about to have with the lender. Rate shopping does still matter. Over a 30-year mortgage, even a 0.25% difference adds up. But the relationship with your lender matters just as much as the rate. Your lender is going to review your bank statements, tax returns, income history, spending patterns, deposits, and assets. They'll see things most people never think about. That's why communication and trust matter so much. I once worked with a couple who chose an online lender. Everything went fine until 3 days before closing the week after Christmas. Their loan officer was on vacation. The person covering their file did not understand and asked for nearly every document to be resubmitted. With a local lender, the replacement would have been down the hall. Instead, it turned into a panic. Distance and call centers make problems harder when timing matters most. A good lender does more than quote rates. They will explain how your income is evaluated, how your credit history is weighted, and how employment, deposits, and existing debts are treated. They should be upfront about which loan programs are realistic and which ones would be a stretch. Nearly all lenders use the same loan application, the Universal Residential Loan Application, which is also called the 1003. When you complete that form, how you complete that form determines how many more questions you'll get later. Fill out every section. If something doesn't apply, write an A. Blank spaces create follow-ups. Clear answers reduce friction. When I worked at USDA Rural Development, we required 2 years of tax returns as a standard rule. Most lenders follow the same pattern. They want consistency, not one unusually good or bad year taken out of context. One of the biggest mistakes I saw borrowers make was sending more documentation than was requested. If I asked for 2 months of bank statements, some people sent 12. If I asked for 2 years of tax returns, some people sent me 5. I even received hundreds of pages of self-pulled credit reports. And here's the problems. Lenders can't use commercial credit reports. They have to pull their own official tri-merge credit report. And once you send any document, whether it was requested or not, lenders are required to review it. That review often raises new questions, slows down the file, and sometimes creates issues that didn't exist before and would not have existed had you not sent extra documentation. The safest approach is simple. Give the lender exactly what they ask for, no more, no less. This is especially important when it comes to deposits. Lenders have to document where your money comes from. At USDA, any unexplained deposit over $100 had to be sourced and explained. Other programs have different thresholds, but the principle's the same. Random, undocumented deposits create problems. So, If you run a small business or have a side gig, and especially if you're paid through Cash App, Venmo, PayPal, Zelle, or Cash, expect more questions from your lender. You may need to provide profit and loss statements, business tax returns, proof that deposits are income and not gifts, and evidence of how long that income has existed. You need to separate business and personal accounts wherever possible. Mixed accounts make everything harder. Student loans are another area that trips buyers up. Even when loans are deferred or in forbearance, they usually count toward your debt to income ratio. Different programs treat them differently. USDA and FHA often use either the actual payment or 0.5% of the balance. The VA uses a calculated payment when necessary, and conventional loans may use either the actual payment or a percentage of the balance, depending on their requirements. You don't need to memorize these rules. The point is this: student loans always matter, and this is why choosing a lender who can explain the rules is critical. And rate shopping is expected. Multiple mortgage inquiries within a short window typically count as one. What does cause problems is new credit activities. No new credit cards, no new auto loans, no new personal loans, no furniture financing, no buy now, pay later plans. Nothing now. And buy now, pay later deserves special attention because some BNPL accounts appear as trade lines on your credit, which affects your debt to income ratio, and others show up as recurring payments on your bank statements. Missed payments can trigger negative marks at the worst possible time. So, if you're preparing to apply for a mortgage, the safest move is to keep your financial life quiet and predictable. And one important distinction surprises many buyers. Your lender is going to know far more about your finances than your realtor ever will. Your lender is going to see your bank statements, deposits, spending patterns, everything. Your realtor doesn't have access to that information unless you choose to share it. And we're bound by fiduciary duty to protect your confidentiality. This duty includes loyalty, disclosure, obedience, reasonable care, and accounting. You can speak candidly with your realtor about concerns or obstacles without fear that the information will be used against you. Finally, loan programs do matter, but lender selection matters more. Most programs can be shopped among many lenders. A few cannot. USDA Direct, which is where I work, for example, isn't offered through banks at all. Other specialty programs use only one or two approved lenders. For most buyers, the correct order is simple. You choose the right lender and then compare loan options, but you need to be aware that some loans make lender choice not a choice. You're guided to the handful that handle that loan. And be aware that if the first answer your lender gives you is no, that's not the end. Step 4 is going to walk you through what to do if underwriting raises issues or your lender tells you no, and how to respond without making things worse. Not now does not mean never. And this is a moment where you stop guessing and start steering.